How's it going? Brian here. Last week I connected with Barry Baboolal, mortgage broker and owner of Complete Mortgage Solutions, an independently owned and operated division of Dominion Lending Centers, to talk about all things mortgage. Now, Barry's been in the business since 1995. He's worked with organizations including Wells Fargo, TD, Scotia Bank, Mortgage Alliance, and most recently Dominion Lending Centers. Barry's been recognized as the #1 in Canada for mortgage volume during his time with Scotia and TD, and he's been ranked one of the top 20 brokers in Canada during his time with Dominion Lending. So he's really qualified to have these conversations. We talked about the basics, the difference between pre-qualified and pre-approved and what you need to know. We talked about what you need to bring and have ready when you're meeting with your lender to talk about what you can qualify for. And we even talked about things you absolutely should not do during the qualifying process for your mortgage. So I think there's a lot of really useful information here. If you find this conversation useful, please like, please share, follow us on whatever platform you found us on. And without further ado, here we go. Okay, Barry, thank you so much for joining us. I'm really, really grateful that you've jumped on with me to talk about a few things when it comes to financing, getting a mortgage, and what the people that we work with are going to need to do before they move ahead and purchase a new home.
Perfect. So Brian, thank you for having me out this afternoon. Real pleasure to do this with you, and always happy to share information with new buyers and with clients of any kind when it comes to mortgage financing.
So let's start with the basics. When people start the conversation with me, a lot of times if they're new to the home buying world, or maybe it's been a while since they've done a transaction, there are a few things that they maybe need a refresher on. And one of the most common ones is the understanding of what's the difference between being pre-approved and pre-qualified, because it can be quite a big difference. So I thought that would be the first question we'd pose to you, and let me know what we should be telling our clients and what the people who are listening are going to need to know about that process.
So let's get right into it. So pre-qualification versus pre-approval. So generally, a pre-qualifier is a view of a client's ability to get a mortgage, but it's provided or it's looked at either through automation, maybe something online, someone's gone online somewhere and entered some information into the system, and the system spits out, a notification saying, hey, based on what you have told me or what you've inputted into the system, this is what you are pre-qualified for. Okay, so it's really based on the information that the purchaser or the applicant entering that information. That pre-qualification is really based on the information that they have now put into that system. There's no one taking a look at the actual numbers or reviewing paperwork or anything of that sort. So a pre-qualifier, while it's a good starting process, it's a good spot to start with if somebody is just sitting there on their couch on a Saturday afternoon thinking, geez, I wonder if I can get a mortgage. And so they can go to an online calculator. We've got one, or an online system. Dominion Lending has got a mobile mortgage tool that we have provided our clients with that can be downloaded on, it's an app that can be downloaded onto your phone, and you can put in your own information and it will give you some parameters on what you can get pre-approved for and so on. A pre-approval is one step further. That is where you're going to actually do a proper mortgage application. You're going to provide your actual income documents, and someone like myself or someone at a bank or whomever you're dealing with, a actual professional is now going to review your documents and your information, and they're going to give you more accurate numbers than what a pre-qualifier would do. Because again, we're going to be able to look at the client's income and say, well, you know, what we can do is maybe use a 2-year income average here and get you a little bit more money. Or, you know, the down payment that you may have put in on the qualifier may not have been accurate. And so this is what we need to do. So a mortgage professional is going to be the one looking at a pre-approval for a customer and giving them more accurate information. And that is the real dynamic there, or the main difference between a pre-qualifier and a pre-approval. One is a little bit more accurate and, you know, sort of guided by a professional, where the other is sort of just an automated scenario that may give you some topical information, but not that accurate.
Okay, so it all comes down to how secure somebody can be with that information moving out into the world. So with that in mind, knowing that people are going to have to come prepared when they meet with a lender, what type of material should they be prepared to bring? What should they be prepared to talk about when they're going to meet with a lender to determine a better idea of what they actually can afford from a mortgage perspective?
So there's some key important items that we look at when we are trying to determine what a client can get qualified for, what size of mortgage, so on and so forth. And there's some very basic requirements. I've made some notes here just to keep me sort of on time as we go through this. So what we like to do is have a completed application with that client, be it the client doing the application online and then submitting it to us. And then we'll make sure that all of the required information is in there: date of birth, social insurance number, current address, length of time at job, things of that nature. All lenders require a bit of history. So we normally ask for 3 years worth of employment history, 3 years worth of address history, and so on. Now, that's not to say that you must be employed for 3 years. You know, you could be employed for 1 year and previously a student. And so we can clean up the application and so on along with the customer, or the clients can input that information. But some very important things to have would be, in the case of somebody who is a salaried employee or working for a company, it is always good to have a current pay stub at hand. If you've been with this company for a couple years, always handy to have your last 2 years T4s. And in the case of a situation where a client may be a salaried employee where they may have just gotten a raise, or potentially just started at a job, it's always good to have a letter of employment that identifies your guaranteed hours and hourly rate or your salary level. Because whenever we're looking at pre-approving a client or getting a mortgage done for a client, your income is really, really important. And so when we have clients that potentially may have overtime and bonuses and so on and so forth, we can use that higher income if we can do a 2-year average for the customer. So it's really helpful to have that T4s that we can do a 2-year average with. Or if you just started a job or just got promoted and you're now going from, let's say, a $60,000 income to an $80,000 income, a letter of employment is really handy to have that will give us that ability to use that income when qualifying a customer.
Okay.
And if I can just go back just to the pre-approval, pre-qualifier, one thing that I wanted to just mention in there, Brian, if I could, and this is really important. And the viewers can certainly Google this information. It's all out there for you to check into. The one important thing that I think buyers in today's world really need to understand is that A pre-qualifier or a pre-approval doesn't necessarily mean that you're automatically approved, okay? There is still a level of underwriting that needs to happen when the client finally finds that property and gets an offer done. One of the trying things for some buyers in this current day market is that a lot of realtors and vendors, sellers of properties, they want the purchasers to buy without conditions. They want them to purchase a home without a condition on financing, without a condition of home inspection, and so on. They're being asked to buy firm. And what that simply means is that they want that purchase to have no conditions. And when you're buying firm, it means that you are buying the property then and there, once it's accepted. So, you know, a lot of my clients have come back to me and said, well, you know, we've been pre-approved somewhere else, but when we went in to get the approval, we were told that we couldn't be approved for this particular property because, you know, maybe it was a rural property, or maybe it was a property that, you know, had some rental component to it, and so on and so forth. So when we're having a sit down and a discussion with our clients, we do pre-approve them, and we always say to them, look, when you're out there with your realtor, when you're out there with Brian, for instance, and Brian is sending you listings to look at, please share those listings. If you see something that you say to yourself, look, you know what, I've looked at the photos, I've looked at the MLS, and I think if I go and see this property and it looks as good as it does in the pictures, this might be one we want to put in an offer on. What I get all my clients to do, and this is an added value of myself and my brokerage, I always get my clients to send me the listing so I could take a look at the property taxes that is on that specific property. I will take a look and see whether or not there's any maintenance fees or condominium fees that needs to be built into the pre-approval of the customer, and give that client a more accurate read on that specific property. So, you know, the client can be a little bit more confident knowing that, you know what, somebody's looked at the details of this property and I'm comfortable enough to say I can go ahead and purchase without that condition or what have you, right? So I just wanted to add that piece in, that just not all pre-qualifiers and pre-approvals mean or is a guaranteed approval. There's more that goes into it after the fact.
Yeah, and I think you bring up a good point, because we have seen instances, especially in this wild sellers market that we're in right now, where people go in, they purchase a property, and if it doesn't necessarily appraise at the value that they are willing to pay for it, there may be a shortfall. So maybe that's something you can tell us a little bit about as well, because we have seen, I personally haven't seen that happen, not with any of my clients, but I have heard of this happening in this market over the last year, where people have gone in, you know, $200,000 or $300,000 over the asking price, and then the bank says, "Well, wait a minute, we're comfortable with giving you that amount of money, but not really for this place." You know, in those instances, what you're offering is you know, going to help people a great deal. You know, what do you advise people doing when they're coming into those types of situations?
So especially after COVID-19 came to town and the real estate market really took off and caught on fire, and it's counterintuitive to think that a global pandemic would create, you know, a fire sale almost, you know, or not a fire sale, but would heat up the real estate market the way it did. But that's what we're dealing with. And to your point about values and so on and so forth, again, having said that, we've got clients who've been pre-approved, and let's say you're pre-approved for a purchase price of $1 million and with 20% down, so you've got a mortgage of $800,000. It doesn't necessarily mean that you could just automatically take that $1 million and buy anything you want with it. The property has to be evaluated, or the value must be there in the property for the bank to approve that, right? So again, this is one of the things that we've sat our clients down and said, listen, you've been pre-approved. However, understand that there may be a requirement that the property be appraised. And so we troubleshoot that a little bit upfront, saying to the client, okay, let's say you did go out and buy something for $1 million, and let's say we had an appraisal that came in $50,000 shy, so it appraised at $950. What does that mean for you as a consumer? What do I need to do to fill that gap, or how does it work? And very simply and quickly, just to sort of advise the viewers, is that when a property is appraised, the bank is going to treat the appraised value as if that was the purchase price. Mm-hmm. So if they're going to give you 80% of $1 million, which is $800,000, if the property appraises for 900, they're going to give you the 80% of the 900, which is $720,000, right? So think about it this way. Now I've bought the property for 1 million. I assumed that I just simply needed $200,000 down, and I was going to get a mortgage of $800,000. Okay, but now my property got appraised for 900, and I'm only getting 720. Well, the difference between 720 and 1 million isn't 200; it's $280,000, right? So now I have to fill. I was catering for a $200,000 down payment. I need 280, so I need somewhere to go to get this $80,000. More often than not, what we're seeing in today's current day market is the bank of mom and dad coming to the rescue and saying, you know what, I'll give you the $80,000 to fill that gap and close that deal. And I've in the year that I've been in, so from January 1, 2021 to now, we have not had one single mortgage not close or one single purchase not close, because we prep our clients for the what ifs. Yep. And so, you know, if you're prepared, it makes your life so much easier just in case. The folks that really run into a problem is when you're not prepared for those circumstances. So if you're prepared, and we've had this conversation with a lot of clients, if you don't have that backup, then you want to be more cautious with getting into a multiple offer situation. You want to, I'm not saying don't participate, but you want to be cautious and you want to be prepared for the what ifs. And as long as you're prepared for the what ifs, it makes your life a lot easier, and you're going to be more successful in getting your deal approved.
You know, and I think that's great advice. And it's one of those things that's really important to set expectations, so that you put yourself in a good position and you don't find yourself running into challenges, because if you can't come up with that extra money, it's a slippery slope. So, you know, we don't even want to go down that road. We want to prepare people the right way. So, and this is why I have you on, Barry, because you're good at what you do, and you set the bar in the right place. So thank you for that. So one of the things, one more thing about in terms of what people should bring with them to meet with you is, it's not always just about their income, right? It's also about their debts. So what do they need on that front? And then that's going to segue great into the next question that I have. So if you don't mind covering that for us, that'd be great.
Yeah, absolutely. So one of the things that I get asked quite a bit, and very, very often, almost every time I get an application in, is clients will ask me, will I look at their credit bureau? Will I do a credit check? And the answer is absolutely unequivocally yes. There's some information that we can glean from that credit report right away that is very, very imperative in you getting a mortgage approved. So for instance, if you're putting less than 20% down, you need to get high ratio mortgage insurance. It's commonly referred to as CMHC insurance. CMHC stands for Canada Mortgage Housing Corporation. And it's important for folks to know that CMHC is not the only high ratio mortgage provider out there. There's actually 3 companies. So there's CMHC, which is government subsidized. That is Canada Mortgage Housing Corporation. There is Sagen, which of recent, they've just rebranded themselves as Sagen. It used to be Genworth Financial, which was an offshoot of GE, the same people that make your fridge, stove, washer, dryer. They were Genworth Financial, and they have now recently rebranded themselves as Sagen. And then finally, Canada Guarantee. So there's 3 insurers. Now, where that ties into the credit bureau and looking at someone's credit and why it's really important is if you've got a purchaser that is putting less than 20% down, these high ratio mortgage insurers have very specific requirements for people's credit. They need to have a credit score of 680 or higher. They will look at scenarios that are less than 680. However, they may turn around and say, we'll approve this mortgage with this purchaser being less than 680 credit score, but we want a higher down payment. So we may not allow this person to do 5% down. We may want this person to put 10% down because their credit is a little bit weaker. So these are some important things that we look at. The other thing that is very, very important when it comes to credit reports and how it impacts high ratio mortgage financing or high ratio mortgage insurance is the high ratio mortgage insurance want clients to have established credit. So if you're just out of university or you're brand spanking new working, you may have 1 credit card. The requirement of the insurers is that you have 2 major credit cards open on your credit report for at least more than 1 year. And so if you apply, you may have a great job and great income, but if you haven't established credit, you will not be approved for a mortgage, even though everything else is in line. You have your down payment, you have a great job, you have great income. The credit is a big, important piece to the puzzle. So, when we're sitting with a client and we're pre-approving somebody, and I'm not saying pre-qualifications here, I'm being very deliberate when I say pre-approving someone. We always say to the client, we need to take a look at your credit report. The other thing is that sometimes people will come to us and they'll say, I've done my own credit report. I've gone to Equifax Canada or I've gone to TransUnion online and I've requested my own credit report. Here you go, use that. What folks need to also understand is that there is a lot more information that we see as lenders than is going to be provided to you on your personal credit report. And it looks completely different. What you get online or what you have paid for and what you've gotten from TransUnion or Equifax will look entirely different and have a lot less information than we get to see as lenders. And it's really, really important. One of the things that is really, really important for purchasers to know is that you need to make sure that you look after your credit. One of the things that create a negative response from lenders is when clients have missed payments within a full year prior to the mortgage application. They look to see that if the client has missed any payments in the last 12 months, right? If you have, that's something that we need to explain to the lender. Why did it happen? And there's sometimes very, very good explanations of why that payment wasn't made, or what have you. But those are things that we can address with a proper credit report up front so that there's no surprises later on, right? So if you haven't, if a lender have not seen your credit report and they have given you a pre-qualifier and just assumed that your credit is great, that could be a real issue when the time comes. If you come in with an actual mortgage request, you come in with a purchase and sale agreement and said, well, you've pre-qualified me, here's my purchase and sale. Now the lender looks at a credit report and found out, there was a cell phone bill that you missed, or there was a student loan that came due, and because you weren't aware that it came due for repayment, there was a missed payment or something like that. That can be a hindrance to you getting a mortgage. And so by us looking at your credit report and ensuring that there's no hidden or no unknown sort of scenarios that can affect your approval, will again make you more successful in getting a mortgage. So credit reporting is really important for us to take a look at.
Okay, perfect. And I'm glad we got a chance to cover that, because I think it is, there's two sides to the coin. It's what do you bring in terms of income and assets to the equation, and then what do you bring in terms of debt and reliability into the equation as well, to make sure that you're going to get qualified. And I know from my role as a real estate agent, it's really important that people are sound and they know what's happening, because especially nowadays, we're talking about bigger and bigger numbers on homes. We want to make sure people can handle it. Okay, so that's awesome. One thing I want to take a quick sidebar here. One of the things you mentioned when you get into pulling credit reports, a lot of people ask me, Brian, if I speak to a lender and they pull my credit report and I want to shop my rates, will that negatively impact me? And generally, I try to tell people, find a lender that you trust, that you work with, before you fill out an application. What is your take on that? What is the best practice for people to have when they're going out and they want to work with the right person and make sure they're getting the right advice? How could that impact them if they start maybe over shopping a bit on their loan?
Right. And just to add to that as well, I always have this, people are overly concerned about their credit score because it's been such a hot button topic in the industry over the past few years. Folks are very scared of having a lender look at their credit report and so on and so forth. So let's talk about why some people will come to a mortgage broker. When you're trying to go, let's say, rate shopping, if you will, if we use that terminology, and you're applying everywhere, you walk into bank 1, bank 2, bank 3, bank 4, bank 5, and everybody's banging away at your credit report, it won't affect your score at that moment in time. Your score is going to be a little bit lower the following month. Okay. And understanding what changes your credit score is, a bit of a mystery for some people, right? And it's like, they feel that, there's a guy like me sitting there going, oh, I'm going to change Brian's credit score today. I'm going to lower his credit score, or I'm going to increase his credit score. What's really important to know is that your credit score is a combination of a few factors that gets recorded in a computer system. And that system has algorithms built into it. And the reason why your credit score drops after you've done 5 or 6 consecutive credit inquiries is that the system, it's a computer, it's an algorithm. It doesn't know that you're shopping around for a car. It doesn't know that you're shopping around for a better mortgage rate. It doesn't know you as a person. The algorithm is picking up on 5 inquiries back to back, and it is thinking, it's built and it's programmed to think that this person is credit seeking. Credit seeking means I've gone to one creditor, and they didn't approve me. So now I've gone to another guy, and now I've gone to another guy and another guy and another guy. That is a negative thing, right? But the system doesn't understand that you are doing a positive thing, which is simply shopping around for the best mortgage or mortgage rate or what have you. And so this whole dilemma that people have about, people sort of going in and having a look at their credit report, rightly so, you don't want multiple bureaus being pulled. And this is where, and again, I'm not, just saying mortgage brokers are great guys. Yes, they are great guys and gals. But that's where a mortgage broker is helpful, in that when we pull one credit report for a client, we can send that file to every single lender we have in our database. So like of lenders, at Complete Mortgage Solutions, we've got 64 currently. We can send the same report to 64 different lenders and get you 64 different options using one report. Whereas you as an individual going out from door to door to door to door is now having that multiple sort of hit, because that lender that let's say lender number 2 is going to say, well, I can't see the bureau that lender number 1 has got, right? Yep. And lender number 3 can't see 1 or 2. And lender number 4, if we continue down that path, they can't see each other's credit report. So they're going to be banging away at your credit report. And this is one advantage that folks who utilize a mortgage broker don't have to worry about it, because once Barry sees your credit report once, it's good. Okay. Yep. One important thing though, a caveat to what I've just said with requesting credit reports and so on and so forth, these things are time sensitive. Okay. Yep. And so if we pull a credit report for a client in January and we pre-approve them, that pre-approval is good for 120 days. Okay, so if they don't buy a house within that time frame, and let's say they come to us in June and say, hey, I've found a home now, we are going to need to do a new credit report at that point in time, because these things are time sensitive and lenders need a current credit report. The time frame is 30 days for a lender. So if you are 31 days out, the lender is going to want us to do a new credit report as well, just so clients out there and viewers understand as well. Some institutions will do their own. Even after we have provided them with a copy, they may do their own. So I've had the other day a client call me up and said, you did my credit report and my file got submitted, but then I got a notification that Scotia Bank also pulled the credit report. Why? And sometimes, a lender may want their own report. And the reason for that is that when you bring that file in, it's just as if you gave me your own report that you've got from Equifax in the mail. There's no way for me to put that information into my system. Some of the banks have very accurate systems where they cannot assimilate our information into their portfolio or into their system. They need to pull it themselves in order for that information to be sucked into their underwriting platform. And that's why sometimes you will have, even though the mortgage broker may have given them a file that they just pulled today, tomorrow they're going to pull their own. And that is because of their own system's requirements, right? Do not worry. Do not worry, because again, you are in the process of getting your mortgage done, and lenders understand that. And if they see Royal Bank, BMO, CIBC, they understand what's happening. The client simply went there and looked at a pre-approval or whatever have you. The other side of that equation when it comes to your credit score and how many times people have looked at it. Again, if your credit is amazing and you're at 800, your credit score after 5 credit reports may drop to 780.
Yeah.
Understand that 780 and higher is already an A score, okay? So you're no worse of a client. If your score is 785 and Barry's 785 and Barry's 780, we're still getting approved at the same level. It's not going to affect our interest rate, because there's bandwidth for those credit scores. So don't let those little things scare you away from going through a proper pre-approval process.
Yeah, I guess at the end of the day too, what you pay, achieving your goal in terms of the best mortgage product and the best rate possible, you're going to save in the long run. And by operating in a way where you are reducing the amount of credit bureaus pulled to begin with, you can handle that a little bit more. So I think that makes a ton of sense. Certainly to me, it does. So, and it's a great segue into the next thing, because one of the things I often hear from people is, well, I have my rate guaranteed, I'm good, everything's groovy, and I still tell them, there's certain things you probably don't want to do between when you get that approval and when you close on a deal. And people aren't always aware of this stuff. So I thought that's a good question for you, is what should people absolutely not do when they're going through the approval process and right up until when the home they've purchased is actually closing? Because my understanding has always been there's no guarantee of that mortgage until closing. So you have to maintain a solid record right up until that point to ensure that you're going to have the funds.
Yeah, so there's some really big don'ts there. As far as the do's are concerned, make sure that you keep your credit running properly. Make sure that whatever agreement that you have with that lender is done. So for instance, there are times when a particular debt structure needs to be removed in order for the mortgage to qualify, and there's a condition on the mortgage where you need to give the mortgage broker proof that your debt structure is paid, or something needs to be taken care of along the lines of some condition. Make sure that you get those conditions fulfilled as soon as possible. Don't leave it for last minute, because we don't operate in a vacuum. Even right now, we've got mortgages that are closing on Tuesday morning. It's a long weekend, which means the lawyers want to have their files all signed, sealed, delivered, ready to go today, so that when they open their doors on Tuesday morning, they don't have to open a file or start working on a file. It's closing day, right? Because they lose the weekend and the Monday as well. So, again, make sure all your conditions are met. You have spoken with your mortgage professional or mortgage broker, and your file is broker complete. There's nothing outstanding. So those are a couple of the do's. The absolute don'ts, okay, is change your debt structure for in the sense of adding more debt into the equation. In today's world, because the real estate market has exploded and prices have gone higher, everyone I know is borrowing to their maximum capacity in order to close on these properties. And what that means essentially is that we're on a hair trigger with regards to the balance between your debt structure and your ability to qualify for that large amount of mortgage money per se. And so a very small change, i.e., maybe buying a brand new car and going from a $400 car payment to a $600 car payment, or a $400 car payment to even a $450 car payment. If you're on the hair trigger as far as your ability to qualify for that mortgage, that is going to become an issue for you, right? So you definitely don't want to increase your debt structure after you've been approved. And if you happen to have an issue where, let's say, a lease came due and you were forced to turn that lease in or whatnot, advise your mortgage professional right away that this is happening, to ensure that you are not disqualifying yourself from that mortgage approval by changing leases or getting a brand new car. Or one of the real big things here is co-signing for someone else. Sisters co-signing for brothers, or brothers co-signing for sisters, moms co-signing for all the kids, or dad or parents. Whenever you co-sign someone's debt, as little as it is or as big as it is, you are now drawing that entire payment into your debt structure. So a lot of people think that co-signing is a benign activity. It is not a benign activity. It affects your ability to qualify for your lending. And I can't tell you how many times people will call me up and say, well, I co-signed for George and Janice, and so Barry co-signed for George and Janice, so really I only signed for a third of the payment. No, co-signing means that you're taking on responsibility. If George and Janice doesn't pay that car loan, or they don't pay their, it's all on you, right? And so lenders will take that entire payment into consideration. So do not co-sign for especially mortgages, right? Because you're going to put your qualifications and your mortgage at risk if you co-sign for somebody's mortgage. Sometimes people would co-sign for things that, you know, maybe a small debt, and then we find out about it and we go, okay, that's got to get removed, and they're able to get themselves removed from that debt structure, or maybe the person pays off the credit card or something like that, and we could fix the problem. But if you co-sign somebody else's mortgage, there isn't an easy fix to that, right? Yeah. Because it's a large sum of money, and if the person that you're co-signing for needed you to qualify 6 months later, or 30 days later, they're not miraculously going to be able to get qualified for that amount of money on their own, right? So do not co-sign scenarios. Do not increase your debt structure. And here's another big one. Do not change your job. And it is a real important item to cover, in that a lot of companies today are converting their own employees from salaried positions to contract positions. Understand that if you've worked for OPG for 20 years as a salaried engineer, and then they say to you, hey, we're going to move you over to being a contract guy. Don't worry, you're all good. We're still going to pay you $100,000+ and so on and so forth. There's a difference, okay? Contract employees are treated in the world of financing the same as somebody who's self-employed. And so if you're going from a salaried position of $80,000 a year to a contract position, potentially you could create a bit of an issue there for yourself. So do not change jobs. The other thing is changing industry. So for instance, if you've been an OPG employee for 20 years, and during the time that you're getting approved for your mortgage, you move to Bruce Power in the same line of work, I can go to a lender or an insurer and say, this guy's an engineer. He's always done this job for 20 years. He's going from OPG to Bruce Power, same line of work. we can get an exception for that.
Yep.
But if you go from being OPG Bruce Power to Brian Stanton Engineering, and now he's all self-employed, or, you know, that is going to become a huge issue in qualifying for a mortgage. So changing jobs can be something that it can be catastrophic. You want to check with your mortgage provider before you change jobs. That's really, really important.
And that can be, my understanding is too, even if you're making more money, it doesn't make a difference, because if you've had seniority before and you've had a place, there's a soft landing for you if something happens. If you move to a new place and you go into probation, you can be making a lot more money, but it doesn't necessarily matter because you don't have the security you had when you were 5 years deep in this other company.
Yeah.
Okay. All right.
Yeah, you know, we can go deeper into that. For today's purposes, we just want to sort of make the announcement, if you will.
Yep.
But we could talk to clients, you know, and again, every single client is an individual scenario, right? Not everybody gets painted with the same brush.
Yep.
And so, you know, for today's purposes, you know, just talking about some do's and don'ts, some very topical scenarios, absolutely. But if somebody's got a case that they want to discuss with us, their own personal scenarios, you can absolutely speak to us as mortgage professionals, and we can guide you through, you know, this is okay, that's not so much so okay, right? And so on and so forth.
Okay. And that's, I think, again, like, before you listen to this, watch this, but when it comes time to start making decisions, call the right people, call somebody like Barry, have those conversations, because it's going to save you a lot of potential stress down the road for sure.
Absolutely.
So with that in mind, I think there's one other question, and I know we're going to be getting close to time here, but housekeeping. We talked a little bit about what people should bring and how people should be prepared. We talked a little bit about employment status. Even if you're self-employed, you may need different things. What are some things that people should have tied up? I've heard some people, you know, they want to apply for mortgage, but they haven't done their taxes yet. What are some of the things that maybe they wouldn't draw a direct line between applying for a mortgage, but that are good things to have done before you go through that process?
Absolutely. So one of the things, and you know, we sort of talked about it a second ago, and it's another hot button topic now in our industry, is self-employed individuals. And it's more so those individuals that need to have things done and in place before they go down the road of trying to get a mortgage and provide documentation and so on and so forth. So a couple of real important things to know. And we just talked about, folks, that some don'ts about leaving your full-time job and becoming self-employed, in that every single lender, for somebody who's self-employed, they want 2 years of full self-employment time frame. They want to see your T1 generals, your tax filings for 2 years, the notice of assessments which go along with those tax filings, and this one's really important, any taxes that's owed to CRA, even if it was $50, a lender wants to see proof that all taxes owing to CRA is paid in full, right? So if you're self-employed, you want to keep at the ready your full T1 generals. A lot of times your accountant will give you a summary version or a condensed version of your T1 generals. The banks want the full T1 generals, all of the pages. And so you can easily ask your accountant to provide you with that in email format, email it to us. We will then in turn send it on down to the underwriting departments. So again, your T1 generals, your notice of assessments, making sure that your taxes are paid, are really, really important things to ensure that you have, especially if you are self-employed. If you're a salaried employee, all you need is job letter, pay stub, 2 T4s, and you're good to go, okay? So really there, as far as having your taxes done, it is really more so the most important thing for folks that are self-employed or contract employees.
Yep.
Right? That's really, really important. One other thing, which is now a COVID-19 occurrence, is that lenders will not review a mortgage application for someone who's self-employed if they're still collecting CERB. So any type of situation where we have a self-employed individual, the regular banks now are asking us to provide last 3 months history of your business bank statements, or if you are not incorporated and you have, you're using a personal account for your business, they want to see 3 months worth of bank statements to ensure that you are not currently collecting CERB. If you're currently collecting CERB, they will not process a mortgage for you.
Okay. Okay. Good to know. Good to know.
Okay. And that's a COVID-19 occurrence, something that is a little bit new to the industry, where we've been tasked to now collect this 3 months bank statements to kind of go along with the other items that we're providing.
So it just shows, right, this whole conversation, that there's a lot for people to think about. It can be simplified if they go and organize, they're talking to the right people. They can make sure that they're getting, they're pulling the necessary information ahead of time. They can make sure the process is going to go smooth. They can avoid the hiccups of changing their debt structure and forgetting about how that could impact their loan. I think this has been really incredible, Barry. It just speaks to the amount of knowledge that you have. And I'm incredibly grateful that you joined me. I think we met in 2012 at the tail end of your time at TD. And when Jen and I were actually getting our mortgage for the home I'm in right now. And I have always looked back fondly on that experience. And so I'll go back to 2012. I want to thank you for that. And all through the years in between, you've done a great job of staying in touch with us and connecting with us and being, overall a great professional. So I'm always happy to refer clients to you. And I really appreciate you taking the time to do this. I think it's incredibly informative for everybody. And so if you want to connect with Barry, you have questions, you have information you're looking for, you're thinking about making a change, you're thinking about purchasing a home, please do get in touch with them. Barry, how can people get in contact with you?
So you can absolutely go to...
People are trying to get in contact with them right now already. We haven't even given the number.
Didn't realize that button wasn't turned off. So you can absolutely Google me. You could also go to our completemortgages.ca website. There is a contact button there. We can share through Brian, we can absolutely share all of my contact information, email. My cell phone is always on 24/7. It's been on since 25 years ago. I've had the same number for 25 years. I've never changed my cell phone number. So, I'm always accessible via email, online. And again, we've got a really great tool, and Brian, I could share this with you as well, and you could share it to your clients. Okay. Dominion Lending has put together a mobile mortgage toolbox. It's an app for Android and for Apple phones, iOS and Android. You could download it and you could do so much with it. It gives you property tax calculations. It gives you mortgage pre-qualifiers that you could do on your own. It also has a direct contact button where you don't even have to memorize my number. You simply press contact Barry and my phone rings and you have a direct access to me all the time. So absolutely, I'd be more than happy to share my contact information with anyone. And through yourself, Brian, you know, we can sort of add my email contact to this as well. And so folks can just simply click on that and email me anytime.
Okay, perfect. Barry, once again, I want to thank you. I want to thank your team, Lisa, Lindsay, and the gang at Complete Mortgage Solutions. You guys are awesome. Thanks again for doing this. And we will be sure to have you back to talk about something else, because there is always something to talk about when it comes to financing. Thanks, Barry.
Absolutely. It's been a pleasure. Thank you, Brian.